Welcome to today's deep dive into the architecture of wealth. Have you ever noticed that there are two ways to be rich? There is the loud, flashy kind of wealth that burns bright and often burns out, and then there is the quiet, immovable wealth of the powerful. The second group operates by a different set of rules. They don't just have money, they have systems that ensure they never lose it, and that it grows even while they sleep. Today we are breaking down the 15 money secrets that the world's most powerful people use to cultivate generational wealth, expanded with the specific strategies required to execute them at the highest level. These aren't just tips. They are the foundational laws of the financial elite. 1. Buy during panic. Most people are hardwired for loss aversion. When the stock market plunges, when real estate prices dip, or when the news is filled with doom and gloom, the natural human instinct is to run, to sell, and to protect what is left. But the powerful understand that crisis creates discounts. When everyone else is selling out of fear, they are buying out of logic. They recognize that markets are cyclical, and that the greatest fortunes in history were made by those who had the courage to enter the room when everyone else was rushing for the exits. They view a market crash not as a disaster, but as a clearance sale on the world's best assets. This requires a psychological decoupling from the herd mentality. Well, the general public looks at the price of an asset. The wealthy look at the value of the asset. If a company was worth $1 billion on Monday and its fundamentals haven't changed, but the market price dropped to $500 million on Tuesday due to a global scare, the powerful see a 50% profit margin waiting to be claimed. They train themselves to view red charts as green lights. 2. Hold cash to act fast on opportunities. You cannot buy the dip if your capital is already fully committed or tied up in losing positions. The wealthy maintain a strategic reserve of liquidity, what investors call dry powder. They are comfortable letting cash sit idle, seemingly doing nothing, because they know its true value is the optionality it provides. This cash allows them to move with a speed that the average person cannot match, snapping up prime real estate or distressed businesses before the rest of the market even realizes they are for sale. This is not about hoarding cash for the sake of security. It is about hoarding cash for the sake of aggression. In the world of high finance, speed is a currency of its own. When a bank-owned property goes into foreclosure or a startup needs a bridge loan to survive a week, the person who can wire funds in 24 hours wins the deal. To implement this, you must have the discipline to not invest every single cent you earn, even when the market looks tempting, always keeping a war chest ready for the inevitable downturn. 3. Saving alone loses to inflation. While you must hold some cash for opportunities, you cannot make saving your primary strategy. Inflation is the silent thief of the middle class. If the cost of living rises by 4%, but your savings account only pays you 1%, you are effectively becoming 3% poorer every year just by standing still. The powerful know that money is like a living organism. If it isn't growing, it is dying. They use their savings as a bridge, not a destination. They understand that the only way to beat the systemic erosion of purchasing power is through asset ownership. This is why the wealthy often hold very little of their actual net worth in fiat currency. They hold it in things that represent real-world value: land, energy, technology, and gold. They understand that the central banks of the world are constantly printing more money, which dilutes the value of every dollar in your pocket. To combat this, they move their wealth into hard assets that cannot be printed out of thin air. 4. Investing grows money over time. Wealth is not built by what you earn, but by what your earnings earn. Every dollar you invest is a financial soldier sent out to capture more soldiers. Over decades, this process transforms a modest sum into a fortress. The strategy here is to move from active income, where you trade your time for money, to passive income, where your capital works for you. The powerful look for moats, competitive advantages in the companies they invest in. They want to own businesses that have such a strong grip on their market that they can raise prices during inflation without losing customers. They don't just play the stock market, they own pieces of the global economy. This shift in perspective is vital. You are not a consumer, you are an owner. Every time you pay a utility bill, a wealthy person is receiving a portion of that payment because they own the infrastructure. The goal is to get on the other side of the transaction. 5. Buy assets, not liabilities. To the average person, a car is an asset because it has value. To the wealthy, a car is a liability because it costs money to maintain. It loses value every day, and it doesn't pay you to own it. The powerful are obsessed with the direction of cash flow. If it takes money out of your pocket, it's a liability. If it puts money in, it's an asset. They spend their early years aggressively accumulating things like dividend-paying stocks, rental properties, and business interests. They don't buy the luxury watch until the rental property pays for it. This is the delayed luxury strategy. Most people use their first big paycheck to buy a better car or a bigger house, increasing their liabilities. The powerful use that paycheck to buy a cash-flowing asset, and then they use the income from that asset to buy the car. This way, the car is effectively free, and they still own the asset that paid for it. 6. Assets must produce income or appreciate. There is no room in a powerful portfolio for dead money. Every investment is scrutinized. Is this paying me a monthly yield? Or is the underlying value growing at a rate that far exceeds my costs? If it does neither, it is discarded. The strategy here involves yield on cost. The wealthy look for assets that will increase their payouts over time. For example, if they buy a stock that pays a 3% dividend today, but the company grows and increases its dividend every year, in 10 years, the wealthy person might be earning a 20% return on their original investment every single year just in dividends. This is how you build a money machine that provides for your lifestyle without you ever having to touch the principal investment. 7. Compound interest rewards patience. This is the 8th wonder of the world because its power is backloaded. In the first few years, compound interest looks boring. You see small gains that don't seem life-changing. But if you have the discipline to leave that money alone, the curve eventually turns vertical. The interest starts earning interest, and the growth becomes exponential. The powerful are not looking for a get-rich-quick scheme. They are playing the get-wealthy-forever game. They have the emotional maturity to wait 10, 20, or 30 years for the full harvest. They are the masters of delayed gratification. They understand that time in the market is more important than timing the market. By staying invested through the ups and downs, they benefit from the long-term upward trajectory of human productivity and innovation. 8. Diversify to reduce risk. No matter how much you know, you can never predict a black swan event, a global pandemic, a sudden war, or a technological shift that makes an industry obsolete. The wealthy protect themselves by spreading their wealth across different asset classes, different industries, and even different geographies. If one sector fails, the others hold the line. They ensure they are never in a position where a single mistake or a single stroke of bad luck can wipe them out. The strategy here is uncorrelated assets. They don't just buy 10 different tech stocks. They buy a tech stock, a piece of farmland, a government bond, and a gold bar. If the stock market crashes, the gold usually goes up. If the city property market fails, the farmland still produces food. They build a financial web that is strong in all directions. 9. Don't rely on one income stream. The most dangerous number in personal finance is the number 1. One job, one client, one investment. If that one thing fails, you are at 0. To counter this, the powerful focus on point 10. 10. Create multiple income flows. They want their money coming from 5 or 6 different directions. They might have a salary, yes, but they also have dividends from stocks, interest from private lending, royalties from intellectual property, and cash flow from real estate. This creates a redundant system of financial security that makes them virtually unbreakable. The strategy here is stacking. You don't try to build 10 streams at once. You build one, automate it, and then use the profits from that stream to build the second. Over 5 to 10 years, you create a diversified income portfolio that makes the loss of any single stream irrelevant to your lifestyle. 11. Focus on essential demand in downturns. When the world enters a recession, the wealthy don't just hide, they shift their focus. They know that while people might stop buying designer handbags during a crisis, they will never stop paying for electricity. They will never stop eating, and they will always need a place to live. By investing in the boring but essential sectors of the economy, the powerful ensure their income remains stable even when the luxury markets are collapsing. This is known as defensive investing. They look for companies with inelastic demand, meaning people have to buy the product regardless of the price or the state of the economy. These are the foundations of a recession-proof portfolio. 12. Negotiate harder when prices drop. In a booming economy, the seller has the power. In a crashing economy, the person with the cash and the calm nerves has the power. The wealthy use these moments to demand better terms, lower interest rates, and steeper discounts. They know that in finance, you don't get what you deserve. You get what you negotiate. The strategy here is value capture. When everyone is desperate to sell, you can dictate the rules. You can ask for seller financing, where the seller acts as the bank. Or you can demand that they cover the repair costs of the property. The powerful understand that the profit is made when you buy, not when you sell. 13. Systems meet motivation, automate wealth. One of the biggest secrets of the ultra-successful is removing the human element. Relying on your willpower to save and invest is a losing strategy. Humans are emotional and prone to distraction. The powerful remove themselves from the equation. They set up automatic transfers where a percentage of every dollar they earn is moved into investment accounts before they even see it. They automate their bills, they automate their portfolio rebalancing, and they automate their wealth building. This is the pay yourself first model. If you wait until the end of the month to see what is left to invest, the answer will almost always be zero. By automating the process, the wealth builds itself in the background while you focus on your life and your career. 14. Expect failure. Few wins drive wealth. This is the power law of investing. You don't need to be right 100% of the time. In fact, most of your investments might be average or even lose a little money. But if you have the courage to stay in the game, you will eventually hit a home run, a stock that goes up 50x or a business that explodes. Those few massive wins will more than pay for all the small failures. The powerful don't beat themselves up over a bad trade. They learn the lesson and move on, knowing the big win is coming. They practice asymmetric risk, looking for situations where the downside is limited but the upside is infinite. 15. Double down on what works. Most people, when they see an investment doing well, get scared and sell it to lock in the profit. The wealthy do the opposite. When they find a winning strategy or a high-performing asset, they pour more capital into it. They recognize that true wealth is built by concentrating your bets on your highest conviction ideas once they have been proven to work. This is winner takes all logic. If you have a business that is growing at 40% a year, why would you take money out of it to put it into a savings account earning 4%? You feed the winners and starve the losers. To truly reach the level of the powerful, you must also understand the concept of tax efficiency. Wealthy people don't just focus on how much they make, they focus on how much they keep. They use legal structures, trusts, corporations, and specialized accounts to ensure that the government takes the smallest bite possible. They understand that a dollar saved in taxes is worth more than a dollar earned in income, because you didn't have to work for it. They also leverage good debt. While the average person uses debt to buy things they can't afford, liabilities, the powerful use debt to buy assets that pay for the debt. If you can borrow money at 5% and invest it in a business that returns 15%, you are making a 10% profit on money that isn't even yours. This is the secret of leverage, and it is how small fortunes become global empires. Furthermore, the powerful invest heavily in human capital. They know that their own mind is the greatest asset they will ever own. They spend thousands on masterminds, books, and specialized training. They realize that the more they know, the less risk they take. Risk comes from not knowing what you're doing. By becoming an expert in their niche, they eliminate the gambling aspect of investing and turn it into a calculated science. They also build social capital, a network of other powerful people. They know that your network is your net worth. Being in the right room allows them to hear about opportunities before they become public knowledge. It gives them access to better lawyers, better accountants, and better partners. Finally, the powerful maintain a legacy mindset. They are not just building wealth for their own comfort. They are building it for the next 3 generations. This long-term thinking changes every decision they make. They don't care about the noise of the daily news cycle or the temporary fluctuations of the market. They are building a mountain, and mountains take time to form. They teach their children these 15 rules so that the wealth is not just transferred, but managed and grown. They understand that wealth is a responsibility. It provides freedom, yes, but it also provides the power to influence the world, to create jobs, and to support causes they believe in. These 15 principles, combined with the strategies of tax efficiency, leverage, and human capital, are the quiet engine of the powerful. They aren't about being smarter than everyone else. They are about being more disciplined, more patient, and more systematic. They understand that money is a tool, and like any tool, it works best when you follow the manual. By buying during panic, holding cash for opportunities, and understanding that saving alone is a losing game, you begin to shift your mindset. By focusing on assets over liabilities, demanding income from those assets, and letting compound interest do the heavy lifting, you build a foundation that can withstand any storm. By diversifying your risk, creating multiple streams of income, and focusing on essential demands, you ensure that you are never reliant on a single source of truth. And by negotiating hard, automating your systems, expecting failures, and doubling down on your wins, you move from being a participant in the economy to being a master of it. This is the path to true, quiet, and lasting wealth. It is available to anyone willing to learn the rules and have the patience to see them through. Wealth is not a mystery. It is a series of deliberate choices repeated over time. Start making those choices today and let the quiet growth of your own financial empire begin. Thanks for watching, and don't forget to like and subscribe. This helps me a lot. See you in the next